Is it time to panic yet? Hey, this is Struzyna with the Gunderman Group at Keller Luxury International. And today is part 2 of the market, where we're at, the update, and then, like I promised last week, where we're going. I'll link to part 1, which is my analysis of how we got here into this current situation, some thoughts to sort of tee this video up. So if you haven't watched that, go check that out. I'll link to it. And when you get value out of this or the other one, hit the like button and subscribe to the channel, because I'm going to continue to put out weekly content just like this, and you are not going to want to miss it. So where are we going? There's a lot of talk, a lot of headlines, both locally and nationally, around a housing correction. And when people hear correction, they immediately think 2008. Well, surely enough, this one is going to be quite different for different reasons and in different quantities and that sort of thing. But nonetheless, a correction is very possible and entirely on the horizon. But there's also more to it than that. So let's talk about this and let's dig into it. The first thing to talk about anytime you're talking about the future of a market, that any article you read, any headline, has to do with inflation. So really, it's like how much buying power does your dollar have, and is it more or less in the future? So when you look at inflation, you look at a lot of industries across the board. Inflation's probably about double what it is normally set at about 2%. Right now it's at 4%. But most articles you're looking at are going to suggest, most experts are going to suggest that it is going to be short-lived, because there's a lot of industries that suddenly went from very minimal demand to a ton of demand, and thus prices went up, or they were closed and they reopened, and so now they're jumping back up to normal levels. And that surge in demand, it's going to take a while to absorb all of that and get back to a normal operational level. And so that is going to affect prices and thus the affordability of those services and goods. But as we sort of adjust to this new post-pandemic world, things open up, whether they close back down or not, that will start to bake into the economy and hopefully will start to level out. Now, the big question mark is, will consumers and will buyers of real estate or other goods and services consider the inflation here to stay and thus affect and change their behavior from a savings, from a spending standpoint, or won't it? That is a really big question that we're gonna have to keep an eye on. So simply, if people stop spending, then there's less wheels turning in the economy, and it might slow down, and thus the whole thing starts to shift downwards, right? One thing to keep in mind. The next thing is the supply chain. I think most people who dig into this question of are we slowing down or speeding up know about the supply chain. We've talked about the price of lumber, we've talked about the cost of labor on this channel and a ton of others relative to building of houses, remodeling, all of that. But what we're also needing to talk about is the materials, not just for homes and for all that, but just across the economy. Take cars, for example. Because there was a shortage of microchips in general, and then the whole supply chain got disrupted for a number of COVID reasons and non-COVID reasons. Now used cars are 30% more than they were, and I've talked to some people who are looking at used cars and they're selling over their original MSRP with 50,000 miles on them. That's a supply and demand issue, simply put. So when the supply chain opens back up and things start flowing at a normal rate, in principle, that should change things to go back to a more normal flow, and keep inflation at a normal level, keep spending and prices at a normal level moving forward. But one thing that is definitely on the minds of myself and a lot of people, especially locally, is affordability. When you look at sort of on a national level, somewhere between a 20 to 40% affordability ratio, meaning 20 to 40% of your income goes to your housing, is what's pretty standard, what most people expect. When you look at California, and definitely in the Bay Area, the average is well in the 50 to 55% range. And historically, that's when you start to max out, when a buyer is no longer able to spend less than 50% of their income on their housing. It becomes sort of a breaking point, if you will. And at a certain point, people will stop spending money, right? So we're there, we're at that level. And so it's reasonable to assume that going forward, people will not continue to push that metric up and up to 60, 70 more % of their household income going to housing. And so you have to assume that unless interest rates drop further, that there's probably no way that they will continue to increase prices the way they have been. We're at a point at which it just doesn't make sense. And nationally, also in the Bay Area, but definitely nationally, housing prices have exceeded wage increases over the last year and a half much faster. And so that affordability becomes a tighter squeeze for people. And eventually everyone has a breaking point ultimately. And I think we're getting there on a price percentage basis. So keep that in mind and watch that one as well. But I think that that is ultimately combined with interest rates, which will continue to go up, which means that the leverage on the money that you have saved for a down payment shrinks a little bit, and thus your ultimate purchase price shrinks as well. So when you roll in the affordability plus the interest on mortgages, how much leverage you can sustain, it's a recipe for prices to remain flat or potentially take a step backwards, which may or may not have a significant impact on the housing market, but all signs point to it not going up and up and up. However, that doesn't mean it's necessarily going to crash. We could remain flat. We could have low 1, 2, 3% growth year over year for the next few years, as opposed to the 7 to 10% nationally, and sometimes 20 or 30% given a certain market that we've experienced, especially when you consider building. There is a lot of construction starting to happen, especially in some of these major metros. Even here locally, I see a fair amount of cranes in the air. I was just on vacation in Seattle, a ton of cranes in the air. And so as the supply chain comes back, as the cost of lumber and materials and copper pipes and all of those sorts of things come back to a normal level, construction in principle again should continue. People should be able to continue to build and create more units. Granted, we are hellishly behind on household formation versus unit creation. So that's why we have such a housing deficit. We've talked about that in other videos, but ultimately that is something that could start to take some of the supply and demand imbalance away. And so if you get more supply and buying power shrinks a little bit, that will start to equalize and bring prices down from a high level down to a more normal level. And that's kind of what I'm seeing and what I'm thinking is going to happen over the next couple of years. Is the frenzy isn't going to exist in the same way. The overbidding and the crazy escalation clauses and things that people are putting in, or these ridiculously high preemptive offers in mass, are probably going to start going away. Now, that doesn't mean that there won't be houses that sell for well over the ask or crazy ridiculous price per square foot. But what it does mean is that the market will probably cool in general and take a more softer approach over the next couple of years. There are a number of factors that could easily change that, of course, but as of right now, based on what I'm seeing, what I'm reading, and what I'm also experiencing here locally, that is my prediction, and that's what I think is going to happen. So if you are considering hopping into the market, that doesn't mean that you're necessarily going to lose a bunch of money on your house or you're going to get a screaming deal all of a sudden, but it does mean that you may not have to continue to climb over every comp every single time something comes on and beat it in order to succeed. You might just be able to be flat at the dollar per square foot average of the neighborhood and be successful there. That's my hope. That's what I'm starting to think will happen, and we'll see, I suppose. But anyways, hopefully you got some value out of that. And if you did, give the video a thumbs up and subscribe to the channel, because I'm going to continue to put out weekly content just like this, and you're not going to want to miss it. So without any further ado, this is Hans Struzyna with the Gunderman Group at Keller Williams Luxury International signing off for now. See you on the next one.